Okay, we are live. We'll take a quick second here to allow everyone to load in to today's REEP Huddle. We have a very healthy viewership today. We appreciate everybody joining us right around lunchtime. My name is Jack Folden. Of course, I manage strategic partnerships and investor relations here at REEP Equity. It's great to be on another REEP Huddle. Today, I have the pleasure of talking with Blake Davis, our Director of Acquisitions, around what we're underwriting and seeing on the acquisition front today. With that, many of you I've spoken with and you know a little bit about me, but I'd like to hand it off to Blake here very quickly, perhaps just to run through a little bit about your background before we get into the Q&A.
Yeah, sure. Pretty diverse across the finance spectrum. Post-college, I spent 2 years in investment banking. Um, Spent 2 years at a hedge fund in Austin, Texas, and then kind of made my way out to Park City, Utah to work at a special situations private equity fund. So I've been underwriting various deals since the beginning of my corporate career. Post that, I had started and sold the company and then made my way to a real estate fund in Austin. Was there for about 5 years, worked through hundreds of transactions, closed on about $8 billion worth of real estate during that period. And then post that job, came over to REEP. It's been an awesome experience so far. Been here about 6 months. The culture, the environment, the team, it's been phenomenal to date, and happy to be a part of it.
Awesome. Thanks, Blake. Well, probably before we get into the Q&A, and just so everyone's aware for the structure today, we have some questions written down. Blake will speak a little bit too, and then probably the last 5 to 10 minutes or so, we'll go through a bit of a Q&A from participants, excuse me. So please feel free to ask your questions in the chat and or Q&A features. The webinar is being recorded today, so if you need to jump off the webinar for any reason, we're happy to distribute the recording, of course. So maybe just a little bit before we jump into some of these questions as well, Blake, appreciate your background. Maybe talk a little bit about what you're seeing in the market as far as acquisitions pipeline. I know you guys are underwriting tons of deals, Dallas, Fort Worth, San Antonio, Houston, Austin. What kind of deals are we seeing across the pipeline? Are they stabilized deals, distressed assets?
Yeah, no, I'd say 90%, maybe even higher. 90 to 95% of the deals that are coming across my desk currently are distressed in some way, shape, or form. Typically, that is going to be a balance sheet or a capital stack issue. So the real estate itself isn't distressed. It's more of the entry point for the previous investor that is forcing the distressed environment. Also seeing a bunch of lender-owned deals come across my desk now. So anything that was purchased in 2022, 2023 is seeing some serious pain. A lot of that was purchased on floating rate debt. They now have maturities that they have to deal with, and rate caps have expired. And a lot of them are being kind of forced out of their position. So a lot of lender-owned deals and a lot of distressed capital structures coming across currently.
Great. And I know many of our participants today actually haven't invested with us. So you described kind of what a distressed deal may look like. Could you speak a little bit to what a stabilized deal looks like? And then maybe to partner with that, why do we pursue both? Or why does a distressed deal make a desirable investment opportunity? Why does a stabilized deal make a desirable investment opportunity for real estate investors?
Yeah, so the outcome is a little different for both classes. So again, then I would say there's two different types of distress, right? So you have physical distress of the property. That's a different business plan. And then you have kind of the capital structure distress, different business plan. So on a distressed deal, typically the returns are going to be outsized and they're going to be back-end weighted. They don't cash flow the same as a stabilized deal.
And when you say back-end weighted, you mean probably a higher equity multiple.
Yeah, you're gonna
Just to
get a higher IRR, you're gonna get a higher equity multiple,
Okay.
and that usually comes through a transaction, whether that be a recap or a sale at the end of the deal. So typically speaking, and it's asset by asset, obviously, every deal is different. But typically speaking, especially for physically distressed deals, the first 12 months of that, um, you know, the idea is that you're repurposing and renovating the asset, so the cash flow profile is limited. In the back half, you probably catch up back to par with a stabilized deal, and then your outsized return, which is your equity multiple, is going to come from the sale or a refi. And then what I would define as a stabilized deal typically is going to be 92% occupied or greater. You're focused on the actual cash flows, recurring cash flows at the asset. A lot of times those will have a pref piece on them, and investors can kind of bank on a stabilized business plan and money distribution schedule. That's kind of the difference. Now, typically speaking, the stabilized assets don't return the same as a distressed deal because you're not taking on as much risk. So distressed deals, typically outsized returns, kind of stabilized deals, distributions, quarterly, monthly, et cetera, and lower return profile.
Perfect. Okay, thank you. Um, Now you mentioned probably about 95% of our acquisition pipeline is comprised of more distressed assets.
Currently.
With that being said, I think this in a way already answers this question. Why do you believe now is a good time to buy or a good entry point, um, rather than waiting for further stabilization in the multifamily market?
Yeah, so again, in the investment philosophy that I've been taught, the idea is to be optimistic when others are fearful and be fearful when others are optimistic. And we're coming across a time right now where there's a dislocated pricing due to forced transactions, right? So you have this massive debt load across the country, really, but especially in Texas. And these transactions are being forced upon current equity holders due to the debt profile that they put onto these properties in 2022. And so a lot of the investors currently in these deals, they would love to stay and try to hold for, another 3 to 5 years, but they don't have that option. They've run through different mechanisms of capital calls, different resources and partners, and they're out of time and they're out of money. And you're actually seeing that with lenders as well. So lenders are starting to capitulate. They're out of time as well. A lot of the times they have locked in funds and they have a redemption profile that they have to meet. So with all of that happening, you're starting to see people sell at prices they would never sell at. And that's usually a great opportunity to get involved.
So sellers selling at prices they wouldn't have before. Maybe elaborate on that a little bit, right? I know we're starting to see some lender-driven deals as well. You talked a little bit about earlier. So are we starting to see lenders take a haircut even?
Yeah, absolutely. So if 90 to 95% of the deals I'm seeing are distressed, I would say, man, 50% of those has been a full equity wipeout. So there's no either through foreclosure, deed in lieu, or just a transaction sale. There's typically no money left for the equity holder. And we're starting to also see, I've seen 10 deals over the last 3 months where lenders are not going to be made whole. So they're finally saying, hey, we've kicked the can down the road for, multiple years now. We expected kind of a different market environment in this moment, and we're no longer willing to wait. And so I think the discounts have been smaller, obviously compared to full equity wipe, but to see lenders start to move through that and take 2, 3, 4, $5 million haircuts on loan balances is material. It's very material. I haven't seen it since probably 08, 09.
Interesting. So let's take a little step back here. I think we've um, adequately addressed the nature of the deals we're seeing in our pipeline, right? Whether they're stabilized or distressed and kind of the factors um, causing that. Let's talk a little bit about market selection and the markets that we're looking at. So for those of you attending today that are new to REEP, for reference, we have 24 properties 10 of which are here in San Antonio, 12 in Houston, and 2 in Austin. So a huge goal for us this year is to break into the Dallas-Fort Worth market, where I know Blake has some experience on the acquisitions front, of course. So of the 4 Texas markets that I just mentioned, Houston, Austin, San Antonio, DFW, which are you most excited about right now, and what drivers are leading that excitement, causing that excitement?
Yeah, I think the two that I'm most excited about right now would be DFW and Austin. Austin's going to be a contrarian opinion that I don't think a lot of people feel the same about in my seat currently. But I think going back to the being optimistic when others are fearful concept, I think that we've seen a ton of supply in Austin over the last 4 years. For the first time in the last 12 months, demand has outstripped supply, and I think now is a great opportunity to get into a very productive and high growth market. And then from a DFW perspective, and again, it's going to be very important to highlight, to evaluate on a submarket by submarket basis. So I think in certain submarkets within DFW, you have just phenomenal economics that are supporting rent growth. There's supporting job growth. We've moved through a ton of supply. And those two markets are kind of where I see the most opportunity moving forward. Houston continues to perform well. San Antonio's sturdy, has worked through a lot of pain points over the last 2 years. So I think that there are opportunities in all 4 markets. I think that the swath of opportunities will be greater in both the DFW and Austin. You just have to be very disciplined on the underwriting front and disciplined on pricing.
Okay, thank you. And somewhat of a general question on each property's vintage, right? So, you look across our portfolio historically, a majority of our assets were built in the 80s to say early 90s,
Yep.
right? Implementing some kind of value add business plan. Um, are you still seeing, across the acquisition pipeline, is that consistent with what you're seeing as far as, these business plans that make sense? Are we starting to see some properties in the early 2000s, the 2010s, where we're able to implement some kind of value add business plan, whether it's operational or truly CapEx driven? Does that make sense?
Yeah.
What are you seeing?
No, I mean, I think the short and sweet of that answer is yes, absolutely. You're starting to see that early 2000s vintage. It's competing with newly built Class A. And to compete with that, there has to be, apples to apples renovation program in place, so people want to live there. With all this new supply that's come on the market, it's been very concession driven. We're starting to see the market move through that. But you still have to give renters and tenants a reason to come to a 2005, 2010 vintage over a newly built Class A. And I think that the 80s opportunities are slowly decreasing. They're still there in abundance, but there's been over the last 8 years a lot of activity in that space, and it's slowed down a ton. I think that 90s and 2000s moving forward is probably going to be the old 80s.
Okay. So kind of becoming the Class B, the new
Yeah.
Class B.
Yeah, exactly.
And with that being said, you talked a little bit about this. By the way, Blake is an Austin native.
I am, so I'm a little biased. I'm a little biased on that
He's a
front.
little biased, and I do like that opinion and agree with many points you made. And I think a huge point, right, amongst all 4 markets in the high growth primary markets in Texas is development, right? A question I get asked all the time, right? What does new multifamily construction look like? Of course, I know we very thoroughly factor that into our location analyses on each potential acquisition. What are you seeing across these 4 markets as far as new multifamily construction, new multifamily supply?
Yeah, so I mean, there's a ton of institutional capital that chased Austin from 2000, I mean, really from 2015 through 2022. So you just had a phenomenal amount of supply come online. And it was great to be a renter during, the last 4 years during that period. You had a lot of options. And you're starting to see the same concept over the last 4 to 5 years in DFW as well. Just a ton of institutional capital. I think Houston and San Antonio have been protected from that somewhat. San Antonio more than Houston, obviously. But it's a story that, once you see it in the headlines, it's already happened and it's already played out. So that's already been priced for all assets in the market. The idea is to underwrite to what the future is going to look like over the next 24 months and understanding the different catalysts and triggers that lead to, high probability of execution and these having correct thesis. So I think Austin, we've moved through a ton of supply. Dallas, it's in process. Certain submarkets have moved through it, and both great opportunities.
Great. And one thing I'll say, I'm obviously Blake's getting a lot of camera time right now, and so if anybody has any questions at this point, please feel free to ask them in the chat or Q&A features. We're happy to address them and speak to them. One thing I think a natural transition from the supply conversation is around absorption, and with that, population trends, right? Population growth. Obviously, during COVID, immediately post-COVID, Texas in general saw a huge surge in population growth, right? Maybe an unforeseen surge in some markets like San Antonio and Austin, right? Whereas Dallas, Fort Worth, and Houston have seen, more consistent population growth over the past decade, right? With that, what population growth trends are we seeing in maybe, you mentioned Dallas, Fort Worth, and Austin as your two favorites. I think there's a lot of people still moving to Dallas, Fort Worth, a lot of people still moving to Austin. We're seeing businesses relocate to Texas. Maybe you could speak a little bit to kind of, population growth trends and how you also mentioned in Dallas, right? We're still seeing in pockets of Dallas that there's positive rent growth, right?
Yep.
And I think in Austin, we'll see that return very soon. Houston, we're seeing positive rent growth. Of course, San Antonio starting to see some positive rent growth as well. So maybe just, generally kind of speak to the population growth trends we're seeing.
Yeah, so I'll start with Houston. I think it's just the most diverse city when you look at different industries across the MSA. So I think there's a lot of downside protection in that factor. I think we're seeing growth across all of Texas, right? Businesses are moving here constantly. It's every headline that I open up pretty much every morning. There's some other business relocating to Texas. So that's a great thing. It's awesome to be here and be kind of underwriting, this space during this time. It makes it much easier for me. With that said, I think Austin has been heavy on tech. You have a lot of it's a younger renter profile, probably 24 to 34, young individuals looking for Class A opportunities. Dallas, it's high finance, a lot of different financial opportunities moving there. I think Citadel recently announced that they're relocating to the DFW area. And so, I mean, pretty much everywhere in Texas right now is gonna see the tailwind from that.
Yeah, no, I think those are great points. And here's a very commonly asked question that I think you can speak to very easily. Obviously, well, really quickly, I'll ask, say January 1st, 2026 to date, how many deals have we underwritten and looked at?
Approximately 200 deals since the start of this year.
So from a dollar
yeah, that probably equates to about $4 billion. So every deal we look at is a little different. Ranges from about 8 million to 35, 40 million per deal. On average, it's looking at about $20 million. So 200, looking at about 4 billion for the year.
Sure. And obviously we haven't bought anything yet this year.
We've not.
We're working on that, of course. But with that being said, what are some of the biggest red flags that are causing us to walk away from these opportunities?
So I would say I'll point to two specifically, right? So from an operational perspective, it's going to be deferred maintenance. So if there's issues, large issues that the price isn't taking into account, say roofs, wiring, there's a whole host of potential issues you can come across, foundation, et cetera. So that's like deferred maintenance is going to be the biggest piece from an operational perspective. And then secondly, there's going to be a capital structure issue, right? So what's currently causing me to walk from a lot of deals is there may be a complete equity wipe, but that's still not the right price. So lenders are starting to capitulate on that front, but they're still holding in relatively strong. So if I underwrite a deal and I think it's materially below the loan balance, and the lender doesn't want to move, there's nothing to be done there, and I think that's happening quite a bit right now. I'm starting to see the wheels turn on that front. I think lenders are finally realizing that they're not going to get a full return of capital. But the two biggest pieces, hands and away, are going to be the deferred maintenance and kind of putting the right capital structure in place.
So a lot of discussion around distress and basically kind of a basis issue on the acquisitions front, right? Um, with that being said, very speculative question. Based on what you're seeing in the market and you spoke a bit earlier as to why this is a good entry point, a good time to buy. How long do you think this wave of distressed multifamily acquisition opportunities will last? Is that the next 6 months? Is it the next 12 months? Just generally speaking. And I know you're not an economist, but just based on your experience.
Yeah, I mean, I think we're going to see it for 18 months for sure. Now, it's going to come in waves. There'll be a little bit of a roller coaster ride on how much hits the market at when. Um, but definitely over the next 18 months, it's going to be very distress driven. Uh, it's already been incredibly distress driven over the last 12. Very few opportunities that I see come across are stabilized in nature. Um, I think we'll get through it by, 18 to 24 months. And I think we're gonna, and I think now is the perfect time to capitalize on that too.
Right. Okay. Thank you. Um, okay. So I know we're at about we've been about 25 minutes into the webinar. So I do see, I think maybe we've gotten a couple questions at this point. We'll dive into those very shortly. Here's one question that I have. In our acquisition meetings, right? I've recently been made aware of maybe some 55 and older active adult living communities, particularly in a market like Dallas,
Yep.
right? And that's a new concept to me,
Yeah.
honestly. We have a history in kind of the, market value add, garden style multifamily, and now we're starting to see some active adult community acquisition opportunities that make sense. So the general question is why do they make sense, right? Why is a 55 and older active adult living community an attractive acquisition or investment opportunity?
Well, I'm going to rewind a little bit and go back to the concept of, hey, we've seen just countless distressed deals come across. So the cool thing, and I've seen two of these deals come across. One looks very attractive currently. The nice thing about the 55 and over is that in a world of where everything's distressed, that's a stabilized play. So right off the bat, the one that came across my desk most recently, you're looking at 95% occupied property with a phenomenal physical asset in place. And then you get down to kind of more of the operational pros is the tenant and renter base is phenomenal in that space. So you're talking about highly occupied, paying tenants that love where they live, that are very community driven, that can afford and withstand and are completely happy with rent increases over time. The typical retention on a 55 and over deal, you're looking at 85 to 90% retention per year. And on average, at a value add deal, it's between 40 and 60%. So you just have all the right factors moving in your favor in that space. Typically, the challenge with a 55 and over asset is the lease up period. If you can find the right deal that has already moved through and transitioned through the lease up period, you just have a really long runway of very stable cash flows and an awesome renter profile. And it's just a great community in general.
Very nice. So very high retention rate,
Yep.
quality tenant base.
Yep.
With that, collections are very high,
Yeah,
right? Very, very low
almost
delinquency.
100% almost always.
Right. Yeah, it's fantastic. Okay, well, I see, first off, thank you, of course, and I do see we have a couple questions in the Q&A feature, so let's take a look here.
I got really bad eyes, so you're gonna any question that's up there, you're gonna have to read for me.
Let's see if I can help. Let's see if I can help. Okay, here's a great question, and I think it goes back to the supply conversation. Why has Texas specifically created this kind of buying opportunity right now compared to other states? I think that goes into probably supply and also just generally speaking, the interest rate environment.
I think that's part of it. I would
Okay.
kind of extrapolate even further and start kind of higher and broader. Is that Texas, just from a regulation standpoint, has been extremely business friendly. And so because of that, you have all these firms moving headquarters and creating this job growth throughout the state. And so with that job growth comes population growth and salary increases, rent growth. So I think it's just a broader, more macro concept that's driving kind of the pros for Texas in general. And then the goal is to underwrite, again, disciplined and pick up on kind of the tailwinds from a macro perspective.
Very nice. Thank you. Lots of interaction here, so thank you all for your questions. We'll try to get to as many as possible. Let's see. Here's a question I think we should touch on. Are you seeing assisted living housing investment opportunities across Texas metros? And I think assisted living, not to be confused with active adult living, right?
Yeah,
Are we looking at any assisted living? I don't think
I'm
so.
not, no, currently. So I'm probably not the best individual to speak to it. I'm not currently geared towards those opportunities. So they could be coming across a greater frequency. So the active living is very different than assisted living. Assisted living, you get into some regulatory hurdles. You have to have kind of the nursing staff and food programs on plan for that asset and that property. It's more of a healthcare space. It's not where my wheelhouse is. The active living is very close to traditional multifamily and just with kind of a better renter profile. So assisted living could be the case. Don't have the information to speak to it.
Sure. And then I think once you get into the assisted living conversation, you start to work with insurance companies.
Insurance and
Right.
regulation as well. It's quite nuanced.
Sure. Okay. Here's a great general question. The big question is, when does the multifamily market turn around? I keep hearing later this year, in 2024, 2025, now 2026. Someone recently told me 2029. Who is right? Of course, before answering that question, the simple answer is we don't know, right? But we can, base our opinions in macroeconomic trends and market trends, right? And I think that goes back to the interest rate environment, supply pipelines, right? We've seen multifamily construction pipeline drastically contract, right? With that, these recent apartment units that have come online are being absorbed, especially across Texas, where we see so much population growth. What would you?
Yeah, and I'm happy to give a thought on that too. So my expectation is that over the next 18 months, we're going to see a lot of lenders capitulate and take haircuts and losses on loans and create a very unique opportunity. So with that said, once the headlines are starting to say, hey, multifamily space has turned and now's the time, it's actually too late. So now is the time. I think it's going to happen over the next 12 to 36 months I will not be able to get the exact month correct. My best guess currently is 18 months, and I'm very confident that now is the time to be a buyer. By the time that the headlines corroborate that story, that opportunity is already passed, and the pricing is in every asset that you see. So we can identify that now is a unique opportunity. We've seen full equity wipes across the board. We're starting to see lender discounts on many assets. This is the moment to be on the buy side. This is the moment to be a buyer. Once those headlines turn, you've kind of missed the opportunity.
Great. So in summary, capitalize on the next 18 months.
Yeah.
This wave of some distressed assets that we're seeing, and beyond 18 months, capitalize on market recovery and valuation improvement, rent growth, so on and so forth.
Yeah. As a buyer now with a 3 to 5 year business plan, by the time that those headlines change, it's probably the perfect opportunity for, an exit. So I think full agreement with that statement.
Great. I think this is a fantastic question. I think we'll maybe touch on just a couple more before we wrap this up. So thank you everyone for your questions. And if we do not get to your questions, please don't hesitate to contact us at invest@reepequity.com. And like I said, this webinar is being recorded, but I think this is a fantastic question. If lenders are taking major hits on debt write-downs to unload distressed multifamily, where are you focusing now on debt originations? And I think there's a conversation there around, right, fixed debt on stabilized assets, but a lot of these distressed deals, it may make sense to take out some floating rate debt, right, in certain instances. So maybe you could speak a little bit how we're underwriting the capital stack from a senior loan perspective.
Yeah, so on the distressed deal specifically, we're in a period of time where we have a unique opportunity to go directly to the lender and negotiate different structures. They cannot get a full return of capital, so they're open to unique ways of either extending for themselves or kind of providing very attractive financing terms. So I think the best path on a lot of these is either through loan modification while taking out the old equity. That's typically the best path. Or you can put on kind of new floating rate with the same lender. Again, you want to be a staunch negotiator during that process because it's a very unique time. But on all the distressed stuff, that's typically my first path is, hey, how can I get the best financing terms to execute the business plan? Because if you get the right capital stack in place, you can typically pick up a couple million right off the front. That's going to boost the investment thesis. And partly that can be the investment thesis in and of itself. It's just a complete capital structure renovation.
Very nice. Okay. Well, with that, I think we'll wrap up here. There are many other questions. We will be able to review them and get back to you after the webinar. And if you have any additional questions, like I said, please don't hesitate to reach out to invest@reepequity.com. Also, if you would like the webinar recording, happy to distribute that. We appreciate everyone joining us right around lunchtime today. It's been a pleasure speaking with you, Blake. Appreciate all the insights.
Absolutely. That's what I'm here for.
That's right. We appreciate it. And we appreciate everybody joining us today. So thank you all very much. And we hope you have a great rest of your day.